I would not be buying anything in the market at all. Just go to cash. There's some days to play, some days to preserve capital. Preserve capital.
You know, Steve Weiss, you're not the only person thinking that. Also, I'm going to hit the abs harder in the gym. I feel like that was like a shot. I don't even know. Brenda.
The show still has 56 minutes.
Yeah, we got to get started early. I know you like the repartee.
Seriously, when I get out of here, right to LA Fitness. Anyway, Brenda, what are you looking at right now? Obviously, you have a lot of exposure to what's going on in the West Coast and the banks and Silicon Valley. Are there any places you can look for opportunity?
Sure. I mean, I think we're in a stock picker's market, maybe not today, but I still think there are opportunities out there. And I think for people that want to have some diversification, having some bonds in your portfolio doesn't hurt either. You know, that's an area that we added a little bit to right at the end of last year at the expense of large cap equity. So I think that there is still a decent risk reward on the bond side. But I think there are still opportunities in the stock market. And particularly, I think we need to wait and see what happens next week. If the Fed pauses, even if it's temporarily, I think that could, cause money to flow back onto the equity side. But I do think the recent events of the past couple of weeks are effectively doing the Fed's job for it. I do think that the economy is likely to slow as a result, if not for less lending, but also just especially in my area where I live in Silicon Valley, I think just when you look at consumer confidence and what's happened with the recent events, there's reason to believe that we may see a pullback in consumption as a result.
Yeah, understandably, a lot of loss of confidence out there in the Bay Area. You know, you guys are all kind of touching on the idea of inflows. I want to go to Michael Hartnett of B of A, their flow show data right now. I think we have a full screen for it as well. $113 billion inflow into cash just this week. Biggest inflow into cash since April of 20. We all know what that was, the beginning of the pandemic. Joe, what does that say to you about the confidence that investors have right now? I mean, obviously it's a lack of confidence, but in general, what does that say to you?
So I'll turn quickly to Steven and say, Steve, close your ears on this. You're not going to like it. From the perspective of a long-term investor, remember your reinvestment risk. Always remember your reinvestment risk. So if you're going into cash, okay, think about the move that you've had in a 2-year treasury from 1 week ago Wednesday at 508 to below 4% and how quickly that happened. If you made that move into cash at that point, you're not feeling very good in those cash yielding equivalents. So the reinvestment risk always comes with the tremendous difficulty of timing back into the market. And unless you could think that you could play the course like a professional golfer, there are some people that can do that and market time their way back into the market from cash. Congratulations, that's awesome. But most people can't play the golf course the way a professional golfer can. And the market timing is nearly impossible. So from an asset allocation perspective, that cash element to me is only going to prove detrimental.
All right, Steve Weiss, back to your point about going into cash. I mean, it looks like we're on course right now to have the biggest inflow into cash this year since Q2 of 20. Again, that was the pandemic. Obviously, a lot of panic and fear then.
It depends what you do with it. So I've been, my final trade consistently has been 2-year treasuries. So they've actually worked out. It's not that I'm not losing money this year. If you have any equity positions, chances are you losing money. So I am, but not a lot, but I'm making money in my bond portfolio. It's not a substitute. Today I was looking at, and I agree, you can't catch bottoms, you can't catch tops. But it's a question of how much time I have to put money in the market. I think I have 6 to 9 months. But I was looking at bank preferreds today. Citi's not going out of business. Their preferreds are going to be money good, right? So maybe you can pick up a 7% yield in there. That's where you should be. You shouldn't be in pure cash, right? Given where inflation is, I mean, that's a declining asset. Cash is always a declining asset, right? So I think you can find places to go. Some things, I actually looked at KeyCorp, right? And I said, that's a little risky. Monstrous yield, 5 times earnings, but is that 5 times accurate or is it 10 times? I don't think they're insolvent, but so they're a place you can go where there's not a lot of risk. And I think bank preferreds are one place.
I think to your point, Steve, we're seeing the biggest inflow into Treasury since May of 2022. Rob Sechan, we did not forget about you. I know you're out there.
As much as we'd like to, Frank, we have.
That's not the consensus opinion, Rob Sechan, not at all. What's your take?
So many investors. That's the token Steve Weiss opinion, Frank. I know that.
He speaks for himself.
We could vote on it, Rob.
Rob, huge inflows into cash this week, biggest since basically the beginning of the pandemic. What does that say to you?
Well, it says that there's a lot of risk aversion out there, and it should be no surprise. Anytime the Fed in 1 year, 12 months, goes from 0% interest rates to 5% interest rates, it's going to expose some folks. And I think we started to see the beginnings of that exposure last week with the failure of SVB. And it puts the Fed in an interesting position in that they're in a catch-22 of fighting inflation or supporting market stability. And I think, the bond market is saying, is the Fed going to pivot more broadly and support markets the way they did in 1998 after long-term capital management, the way they did in 2016 with the oil and gas banking crisis, and the way they did in 2018 with the short-term funding markets? Risk is that if they do that, they cause inflation to become more entrenched. Let's remember, the last times they did that, we had an environment where the Fed's the inflation target was below 2%, or inflation was below the Fed's target of 2%. And the Fed is acutely aware of what happened the last two times, in 98, where they cut and it re-accelerated inflation and a huge asset bubble, and again in 18. And so it's an environment that I think is really tough. I think what we're watching for is what cracks are under the surface that the Fed is going to have to support given what's happening. And it's almost like whack-a-mole. I think we've only seen a few of these shoes drop. But I think next week they have to go 25 for credibility reasons, and they have to go 25 because of the data. And the sad news is they're not going to have a lot more data before the next meeting. So if they do pivot to the bond market's narrative, it's going to be because the conditions have gotten pretty bad. So it has to get worse before it gets better. And so it's a really tough environment to invest. This is why, like Steve, I absolutely hate to say that, we are conservative. We're in more cash. We've been de-risking portfolios. And I think we're playing a waiting game on when we can get engaged again in a really thoughtful way.
Rob Sechan, making up for lost time, giving us the notebook there, Rob. You know what? You're seeing a 25 basis point hike next week. You're not the only one. Let's show a wall. Some very prominent market voices seeing the same thing. We're talking Jeffrey Gundlach, Carl Icahn, and Professor Siegel. All of them believe we're going to see a 25 basis point hike next week. So, Brendan, I want to turn over to you. How would the people in Silicon Valley think about that, and what do you think about the potential of this hike?
Yeah, I think if they don't hike and maybe they wait until May and reevaluate and potentially hike in May if things calm a little bit, I think that message, especially in my part of the woods, would be well received, and an acknowledgement that there have been two bank failures and one bank that's been saved by a consortium of other banks. So there's been 3 banks that have needed either serious help or have completely gone away. So that, in my mind, is meaningful enough for the Fed to potentially pause this month and then reevaluate in May should things calm a little bit. And I think the narrative on inflation, shelter is such a gigantic component, and it's been the stickiest part. But if we think about how regional banks are involved in the real estate market, they're incredibly involved in the real estate market. They do a lot of lending on the consumer side. So I do think that we may start to see some slowing there and prices come down a little bit, especially if relatively decent rate financing is no longer available in some of these markets because the regional banks aren't lending.
Certainly something to consider. Steve, but wouldn't a pause here kind of spook the market? I mean, if the Fed decides not to hike, wouldn't that be a little scary that the Fed is nervous as well?
I don't know what the market would do, because bulls have been focusing on one single data point and glomming onto that and then buying the market, trading the market. So maybe they see positive.